Hello guys, welcome back. Palo Alto Networks just reported its earnings and it's surging after hours, about 11% higher. So we're gonna see what the company is doing and why the stock price is elevated that much in after hours. And of course analyze the financials of the company and see whether it's actually worth purchasing for us. Because the fact that it's up doesn't mean much unless the company is doing well and it's cheap. So let's take a look at what happened in their earnings report. You will see that Palo Alto Networks rockets more than 10% as the company actually hiked its annual guidance a third time. So it looks like they're doing well, or they're expecting to be doing well in the next few quarters. So they saw a strong top line growth in Q3. Top line is basically the revenue. And on the back of this strength across our portfolio, we are again raising our guidance for the year across revenue, billings, and earnings per share. Very interesting. So, they boosted their full year outlook for a third time, forecasting adjusted earnings 7.33 to 7.43 to 7.46, revenue of 5.48 to 5.5, and billings of 711 to 714. And they have already hiked in the previous quarter, as you'll see. You can kind of see the differences here. Substantial differences pretty much, so that's interesting from the company. The analysts expect 7.29 a share on revenue of 5.46 and billings of 6.82. So they are expecting significantly better results here. Very, very interesting to see. And for the fiscal third quarter, they reported a loss of 73 million. That's interesting, actually. The fact that the company has reported a loss is always worrying to me. And we are going to see what to do with this company in detail here when we examine the financials. Now, first thing that I don't like to see here, a P ratio that is very negative. Now, it's better than what it used to be, as you'll see, it's climbing, but it's still negative, meaning that the company is losing money pretty much. The price to free cash flow ratio is positive though, and I will let you know why a little bit later, because we're having negative earnings but a positive free cash flow over here. Outstanding shares are a little bit elevated, about 10%, 9%. In the last 5 years, a little bit of extra share issuance. Okay, that can be bad, but more than likely, I won't be too discouraged by this one. Free cash flow last year, we would need about 7 years of that free cash flow to pay all the total liabilities. Fair, it's a little bit more than I would like it to be. 5 is where my limit is for the most part. And the 5-year revenue growth has been increasing, yet the net income growth has been going down, and I don't like to see that at all, of course. 5-year free cash flow growth also increasing over here, and 5-year total equity growth surprisingly is about the same than what it used to be. And debt to equity ratio fairly elevated here. For every $2.59 of debt, the company has $1 of equity. That's substantially high, and still the returns on equity are pretty high here. That kind of worries me. Pretty low, I mean, negative. And that kind of worries me. That's a lot of debt compared to the equity of the company. The company is not profitable yet. Okay, so let's take a look at the financial statements a little bit. And the revenue has been increasing, so they mentioned that the top line keeps increasing the revenue, which is fair. It is indeed the case. But look at this net income. It's been going down and down, and it's actually record loss here in 2021 was that last year. And the balance sheet, you will see that the company's total equity is about the same than what it used to be. So they have gone up a little bit and down a little bit, and they are still sitting at a similar level here, even though they have been printing some shares. Again, remember, the company has been issuing some shares. Interesting. Okay, so what was it? I think it was like 8.7%, something of that sort, I believe. We can examine that again. Yeah, 8.7% higher. It has been creeping up. Okay. So, let's take a look at the cash flow statement, which is interesting here because the net income is negative, but one of the reasons why net income is negative is the fact that in the net income portion, stock-based compensation, for example, acts as an expense, but it's not a cash expense, and so it's added back to the cash flow statement. So this is how we're getting positive free cash flow here. And a few other non-cash items too. But depreciation, amortization, and stock-based compensation play a very, very large role, as you see here in the free cash flow of the company. And it's not coming from actual extra profitability here, pretty much. It's the fact that it gets added back to the cash flow. Now, okay, this is normal to be added back. It's a normal accounting thing. But I would like the company to also have a positive net income, of course, because remember, this stock-based compensation is an expense for the company, and this is why you are seeing it in the net income. And it kind of gets adjusted here in the operating activities cash flow because it's not a cash expense, and it can really skew your results. That won't happen with our stock evaluation tool because I'm taking net profit into account, net income. So the investing activities cash flow, you will see 1.4 loss here, which is fair, which is normal because the company has been purchasing investments and acquiring some things here, normal stuff. And financing activities, paying back some debt over here, good to see. Actually, no, repurchasing common stock. So they are doing some repurchasing, it looks like. Okay. And free cash flow from 700 million to 1.3 billion over here. So it is increasing, but we know why. We examined that. Next up, I'm taking a look at the stock evaluation tool because we need to know what the company is worth for us if we want to be buying that. Now, the revenue growth of the company has been increasing, and their guidance is actually even higher. So I will go high, but not that high. I will still go relatively high though, so like 15, 17, and 19 for the next 5 years, which is substantial revenue growth. And the net income margins, this is a big problem because they are always negative, as you'll see. And this is a huge problem because the company is not profitable. And this is very problematic because what can you pick here? You need to go with something like marginal profitability. And this is a very aggressive estimate here as well. Because again, the company hasn't been having positive margins. And actually this margin last year was their worst. The second worst, with the worst one being in 2017. So they haven't been achieving much in terms of making this a positive number, although they almost reached that back in 2019. So interesting, but a company is growing. At some point, you would want them to get to profitability levels because you could be overpaying without actually getting anything really here. And so net income margin of 1, 3, and 5, it's still very aggressive. And the free cash flow margin, of course, is going to be negative all over the place because the net income margin is negative. And this, when this happens, I'm going to something like 80, 90, and 100, which is 80 or 90 or 100% of this net income pretty much converted to free cash flow. And the annual return that I'm going to go for is 13% over here. And I hit calculate. And as I would expect, we are much lower than what I would like it to be. And that's basically because the company is not profitable. A big issue here. And this is why our Palo Alto Networks estimate here would probably be at around near $30 or so, with the current price being at $430, which is extremely expensive for what the company is. And so I wouldn't want to come anywhere near this stock. I think that the company could continue doing well and maybe they will achieve profitability, but right now this is extremely expensive for me. And even though it's up 11%, I'm not biting. I actually think that this is even worse because now we're approaching $500 and that makes no sense to me. And this is why I'm avoiding this company. And yeah, I'm passing on this one at least till it gets to much lower levels, which I don't know if that will happen anytime soon. So thank you for watching the video. I hope you enjoyed the new earnings report. Tell me what you think about Palo Alto Networks, whether you are invested or you are looking to get into this one. And please leave a like and subscribe. Thank you for watching the video. I'll see you in the next one. Bye bye.